All right. Good morning, everybody. And thank you for joining us. For those of you who don't know me, I'm Katie Stinchen, the Executive Director of the Massachusetts Brewers Guild. And it was so nice to see so many familiar faces and new faces yesterday at our annual meeting at Lord Hobo. Um, Today's presentation covers finances, books, making sure that your data is solid and that you're keeping track of where things are headed so that you can make adjustments as needed. If you attended our conference last November, we held a session on what it looks like to either close a brewery or sell your brewery. This is kind of a precursor to that. Just trying to help folks understand what some of their red flags are, where they can get ahead of some issues that may, um, you know, prove to be difficult down the line. So I'm super excited to have with us Kary Shumway, who is a long time uh, from the beer industry, a CPA, formerly with CFO of distributors, and then part owner of Wormtown as well as their CFO. So certainly some solid financial backing and history and qualifications here tied to the beer industry specifically. So we're in good hands today with Kary. So Kary, I'm going to go ahead and let you take over the Zoom screen and share your presentation, and we'll get rolling.
Sounds great. Thanks, Katie, for that introduction, and thanks everybody for joining today and those watching later. So yeah, as Katie said, we're looking for ways to spot trouble before it becomes a big problem. And so I think this presentation hopefully can give folks some insights into how we do that exactly. The breweries that I work with, we seem to share a common theme is that we've got so much data, so much information that it can be overwhelming. We're not really sure where to look. So hopefully this can help kind of give you a few tools, kind of shortcut the process so that you can see what are the red flags I should be, how do I know if I've got some problems? Because I think we all know the gut feel is we look at the bank account, if cash is going down, we feel, oh gosh, what's going on? If cash is stable or going up, things must be good. And it's a really hard way to run our business because, that bank account is pretty fickle. So that's what we'll talk about today is how to bring a little bit more reporting analysis so that you can spot those early warning signs before they become big trouble. So these are our topics. I'll take you through 7 financial red flags that can predict or forecast or foreshadow some trouble, and hopefully you can spot those in time to fix them. How to diagnose the root cause, not just the symptom, because very often, we may go in and we'd be like, gosh, I got margin problems, I got cash flow issues, maybe too much inventory, but what's the underlying root cause of that so that we can address that so these issues don't reoccur. We'll talk about this concept of stabilize first, a turnaround framework that you can use to kind of get your footing so that we can, move forward and make improvements. Share a few high impact fixes for cash flow. A lot of times we want just kind of some quick wins. And then I'll talk about building a financial early warning system, which I think is the glue that holds all this together. In a nutshell, it's how do we create a regular financial cadence in our business? And I'm a big fan of the great game of business and open book management and huddles, and sort of borrowed from their concept of weekly huddles as that financial cadence, as that mechanism. So how do we do that exactly? How do we set that up? And what's the agenda? Like, what are we asking people to look at? What numbers? So we'll get into those details. I wanted to make folks aware of the Massachusetts Workforce Training Fund. I know many folks are aware of this already. I've created a couple of programs that are available in there for financial training. And the beauty of the program is that depending on the size of your brewery, you can get up to 100% reimbursement for these programs. So if you scan this QR code, it'll take you to a landing page with a little bit more information. I've got 2 short videos on there. One video is just a very quick overview of what is this workforce training for? How would I sign up for this and how do I learn more? And I should note that on that website, maybe I can drop that in the chat or just you can scan the code, it'll get you there. Um, there's tons of training, not just financial training. So it's definitely worth checking out. And again, depending on eligibility, you can get up to 100% reimbursement. So the quickest way to learn more is I'm happy to jump on a quick phone call or Zoom with you and show you what this looks like and kind of how the eligibility process works. So you basically just go to the site, you fill out a quick application, you upload a few documents, you choose the courses that you want, and then there's a 20-day, 21-day review period by Massachusetts, and they'll get back and let you know your eligibility. So I think it's a really cool program. So when I'm working with folks, there's usually two barriers. It's like I don't have the money right now, not have the time right now. So hopefully we can help with both of those. This will help with the money side of things, and then the time. It does take an investment of time to, learn basically improvements in our financial situation. But we try to do as much as we can to really shortcut and speed up that process for you. So for those interested, scan this QR code. It'll take you to a landing page with more information. All right, so first let's just kind of better define the problem that we're looking to attack today. And one of the big problems that the financial red flags, these trouble spots, tend to be kind of invisible or very well hidden until they become really big problems. So most breweries don't run into trouble like overnight. It's over time, right? There's kind of a slow, problems accumulate, and before you know it, gosh, cash flow is a real problem. So those warning signs are there, but we don't always see them clearly. Our financial statements are great for, what happened. We run the income statement, and that tells us what happened last month, but we don't get it until 2 or 3 weeks into the new month. So not super helpful to kind of forward forecast. It's just kind of telling us where we've been. The balance sheet's just kind of an accounting of, where we are at this present. So we need tools to kind of look forward. We need systems to be able to predict and plan and spot those red flags. So the other challenge is we have so many numbers to look at. We're not really sure what are the numbers that matter. And it's kind of remarkable when I work with folks what numbers they want to start with, and it can be very granular. I think we, as humans, we like complexity, and we like details, and we dive right in, and it's like we can measure those things, but it's really not going to make much of a difference in our business. So we need to start by measuring what matters. So I'll share those numbers with you, but in a couple words, it's measuring cash flow, and it's understanding what are the drivers of cash flow, what are the levers that we can pull in order to make those improvements. So the other problem or challenge that we have is that most breweries do not have an early warning system. There's no regular financial meetings. We'll do department meetings, and we'll do production meetings, planning meetings. These are all great. But I'm talking about financial cadence so that you get 52 times a year where you're looking very detailed at your numbers, where you're at, what your goals are, what gaps there are, and how do you close those gaps. So the solution is to shift from just kind of monitoring the numbers. We get the reports, we look at them, to more of an active, use of these. How do we use these to really run our business, to understand, make data-driven decisions? So moving from maybe dozens of reports, sales reports and margin reports and COGS report, all these reports that we get. So how do we really focus and drill down and grab just a handful of those red flag metrics so that we can create that dashboard? And then obviously, how do we move from sort of reactive to proactive? How do we see this stuff coming? And I should say, when I'm working with folks, I'm not trying to make anybody an accountant, unless you want to be. It's really just how do we get a better understanding of the numbers of our business. So it's really knowing where to look and how often. And, the real magic of it is what action are we going to take to make those improvements? So in summary, here's our game plan. Game plan is to identify those financial red flags early, turn those into action items. What are we going to do? Stabilize our business before we optimize, and then look at those financial signals on a weekly basis. So here I'm going to go through kind of 7 financial red flags that tend to pop up. These are going to be some reports, some tools that you can use. These are the tools that I use as I'm assessing breweries and small businesses to see, how are we doing? So first, I'll kind of take you through the first red flag is a historical decline in net operating income. One of the things that we maybe don't do enough is kind of take that 30,000 foot view and step back and say, let me look at my business from a more macro level. And typically what I'll do is I'll say, I'm going to go back 3 to 5 years, and I want to look at our business on an annual basis, year over year. And I want to look at a very summarized fashion, just sales through net operating income. And what's happening? Is net operating income stable? Is it declining? Is it steady? So we can kind of start with a very high level look at, and that's our first red flag is our net operating income declining over time. The second is, do we have negative or shrinking cash flow? Now, one of the challenges is typically what we'll do with cash flow is we'll look at the bank account, and if it's going down, we feel panic. If it's going up, we feel relief. But that's not we need a better system to obviously be monitoring that. So I'll share with you kind of how to use the traditional cash flow statement, which doesn't get used that often because it can be confusing. But if we've got negative or shrinking cash flow, how do we spot that? The third item is using more granular cash flow ratios. So these are going to be kind of our big 5 or 6 cash flow ratios. What are we going to be measuring? Things like inventory, receivables, payables, capital spending, debt service coverage. And are we on or off target there? So these become very, I think, approachable ways to spot these red flags. The fourth item is a sales decline and or margin erosion. Looking at trend analysis, not just what's happening year over year, but what's happening month over month. So here I like to look at 18 to 24 months, kind of look at what the trends are showing me, spot any potential red flags. The fifth item is wholesale margins are below benchmarks. What we see a lot is breweries going into wholesale because, well, people tell me my beer is great. They are asking me this and that. And before you know it, you know, we are selling a lot of beer through wholesale, and those margins are very different. So we need to be tracking this and understanding what the benchmarks are. You know, where are we right now in our wholesale margins? What are the targets? And what gaps are we seeing? And why are those gaps occurring? So those wholesale margins can be really problematic um, and big red flags there. The sixth item I'll talk about is failing a financial health checkup. So first of all, what is the financial health checkup? What are we? So I'm going to share 4 ratios with you that you can run on your own business and see where you stand there. And I think it's a pretty good measurement of overall financial health on a general basis of your business. And then the seventh item is if we've got these key retail ratios that are trending off target. So there's lots of them we could manage. We typically look at our labor ratios, sales ratios, margins, things like that. All right, so with that, let's dive in. So a lot of the um, numbers that I'm going to show you are just kind of cut and paste spreadsheets. So these are more concepts, but you can run these reports pretty easily if you're using like QuickBooks. So you go into QuickBooks, you do a custom P&L, and I want to look at, say, the last 3 to 5 years. I want to run it summarized so that it's only, maybe these 5 line items, and I want to run it just for the year over year. Now, you may need to drop in some percentages here because QuickBooks doesn't always do that. It doesn't always calculate the percentage margin or net operating income. But the concept here is I want to know where have we been and how did we get to where we are on a high level. And my first red flag is, do I have a decline in net operating income? So we run a report like this, backs us up 30,000 feet. As you can see, it's a snapshot. It's very simple. It's pretty easy to read. I enjoy using percentages in addition to dollars because it's very easy to communicate. So in this example, what is my net income? In year one, going back 3 years, we had net income of 15%, pretty solid. Most breweries 10 to 15% is a really good target. Year two, something happened. What changed? Now I'm at a -3, and in year three, where I am currently, I'm at -12. So now I know, yeah, I got a red flag here. What is going on? So one of the challenges with this analysis, we look at sales, and you can see sales is growing, 525, 675, and up. So as a business owner, sometimes we're monitoring sales and we're thinking, what's going on? Like I'm growing, things are good, people love my product, but that bottom line, I'm getting killed. So then we look at the details. What are our margins? You can see margins are eroding. Operating expenses, a percentage is pretty static, but you can see the dollars are going up. So basically what we have is a situation here where I don't know, maybe we went into wholesale really deep we were just retail and that wholesale margin is so much lower. Maybe we had to add costs in order to do that. So again, this is just a hypothetical example, but it's not far off from a lot of the breweries that I'll look at. So that's red flag number one is just, can you run a report like this? Certainly. Go into QuickBooks. You can do it today. Do it in a summarized fashion, and just go back. I mean, if you've been in business just a couple years, do a couple years. What do the trends look like? If you've been in business for 10 years, I wouldn't go back 10, but I might go back 5 and kind of run this and see what's happening. The other add-on they don't have on the sheet that typically when we look at expenses kind of growing and growing, it's usually payroll. So I would even have a carve out for what was my payroll in year one, two, and three in this example, and what kind of growth am I seeing on that? Is that outpacing margin growth, for example? All right, so that's red flag number one, looking for those declines in net operating income. Red flag number two is, do you have a negative cash flow? Now, the only reason we need a cash flow statement is that typical accounting procedures require that we use this thing called accrual accounting. So when we run a P&L, an income statement, it's usually not a cash basis. It's accrual basis, which means we're recording the sales when they're earned and the expenses when they're incurred, and we have an obligation to pay them, regardless of when the cash went out. So we've got an income statement, balance sheet, and cash flow statement that we want to run on a regular basis. So this is an example of a cash flow statement, and typically we're seeing kind of three buckets. It's telling us what was the cash from operations, from investing, and financing. Now, where we want to focus our time and attention is this operating section, because this is really, does my business produce enough cash from the ordinary day-to-day selling, producing beer, selling beer? Yes or no? Investing is really, what are the things that we're investing in the business? Are we buying new equipment? And financing is saying, well, how did we get the funds to pay for that? Did we borrow money? Was there an owner investment? So if you run a cash flow statement and we focus on operating activities, and particularly this term net operating cash flow, if it's a negative number, we've got a red flag. We've got some problems. This basically meaning the business is not standing on its own and it's going to need money from somewhere. And somewhere usually means the owner has to put more money in, investors have to put more money in, or we need to borrow money, working capital, in order to cover those shortfalls. And it's not sustainable. So we need to first diagnose it. Yep, we got a red flag there. We got to run this on a regular basis, and then we can go from there to figure out what do we do next. So hopefully that will unlock a little bit of help for you in terms of running the cash flow statement, because I do hear this a lot that it's like I run it, I don't even know what I'm looking at, but this is really where to start. Focus on that net operating cash flow. Our third red flag is cash flow ratios that may be off target. So as I mentioned, there's typically 5 or 6 cash flow ratios that we want to look at. We want to watch on a regular basis, and these may be more or less relevant depending on what your business model is. So for example, everybody's got inventory, so we want to track that. Everybody's got accounts payable. Most breweries have, if you have debt, you got debt service. Accounts receivable may or may not be a thing. If you're in wholesale, if you're self-distributing, certainly it is a thing. And it can be pretty significant and quite a nasty surprise if we don't manage it. So for our red flag, what we want to do is identify what are these cash flow drivers, and then what are the targets? Where should we be with these? And then be able to see if we're off target. So I'll take inventory because that's the most common one that can really suck up a lot of cash. And typically what we'll look at with inventory is like, how do I know like how much inventory should I have? Like what's the right number? Because I don't want too much because then it sucks up cash. I don't want too little because then I run out of product and that hurts sales and it's bad for everybody. So what's the right amount? So first we start by quantifying and using a concept called days on hand. So that's where we can use inventory turnover. I like days on hand because it's basically telling me if I took my inventory right now and didn't add a thing to it, how many days could I sell before it run out? How many days of sales on hand do I have? So we first start with a calculation is what's our goal? So the goal would be, I want to be able to replace this inventory on a regular basis. How much time, how much lead time do I need to package new beer? Maybe I need 14 days, maybe I need more. But if we set a goal on that, say it's 14 days, that answers the question of what's the right amount of inventory. 14 days on hand. And then we want to measure where are we at relative to that target. If we're at 21 days on hand, it's significant. That's about 50% more. That's telling us, look, based on our goal, we have too much inventory. Too much inventory means it's consuming too much cash. It also introduces other potential problems like out of code products, spoilage, breakage, things of that nature. So overall, this is a big number to watch. Now, in this case, we've got a red flag. Our days on hand of inventory is higher than our goal. So we know we need to do something. We need to dig in. We need to look at it. And then you get into the details. Okay, days on hand, what products are high? Do we have too many raw materials? Is it packaging? Is it finished goods? Which finished goods? And then we can right size that inventory. Maybe we order less, or we're gonna do different things. But the first step is identify if we've got a problem there. Accounts receivable, I'll cover this quickly. If you're again selling to a wholesaler or you're self-distributing and selling to a retailer, accounts receivable, as you know, is just uncollected sales. We've made the sale, we didn't get the money. Every state is different. Um, if I'm not mistaken, I believe Mass has 60-day credit terms on alcohol. New Hampshire's got a 15-day credit. Vermont's it's all over the place. So if we're in a situation where we're in a credit state, this accounts receivable number can be a significant impact on cash flow. It's money we should get eventually, but the cash cycle is really what we want to focus on is how do we speed that up? So in this case, we're going to do the same thing. We're going to identify what is the ratio and are we on or off target? Do we have a red flag? So in this case, our ratio we're going to talk about is days outstanding or days sales outstanding. So that's just showing us how many days worth of sales are sitting in accounts receivable uncollected. And in this case, we do our measurement. We say we've got 35 days worth of sales sitting there outstanding. Our goal is set. We say, well, our goal is 25. So we're at 35. The goal is 20. There's 10 days sales that we should have in our bank that we don't. So we really need to drill down. So I've got a red flag. So now I say, all right, what do I do next? Next, we're going to review that accounts receivable aging. We're going to dig in and see if we've got, late payments. Certainly, it looks like we do. If you've run these agings, you can see there's buckets of like 0 to 30 days, 30 to 60 days, and so forth, and really focusing on, those older items. But the real key to managing accounts receivable and improving this cash flow ratio is to have a good cash management policy, good credit terms, good follow-up, clean numbers so that when invoices and statements go out, they're accurate. Nothing can kill your receivables worse than a customer gets a statement, an invoice that's like this is wrong. Now you're arguing. Now you're trying to fight to get it. It's not a good scene. So we got to have good, clean data and a good management system. So that's kind of the idea here: is identify those cash flow ratios, set targets for them, understand kind of how the calculations work, and then measure these on a regular basis. Now this I have this labeled as daily numbers key metric scorecard. It doesn't necessarily have to be every day, but the more frequency with which you run that financial cadence, you run these numbers, the sooner you're going to spot these red flags, and the sooner you can do something about them. So this is a scorecard that I used to use. I found it helpful to just kind of keep on track. As you can see, it's also got some other numbers in here, like what's our cash on hand, what's our available line of credit if we have one, debt service. I'll get into that a little bit more later. But these are items that can really help you kind of keep your eye on the ball. The fourth red flag and kind of how to spot it is using trend analysis. I love these. I just love them. You always find something. So usually I'll run a 12, 18, or 24 month trailing monthly P&L. And in this case, we're talking about margins. And specifically, do we have margin erosion month over month, or do we have margin volatility, meaning one month of margin is great, the next month it's terrible, and then the cycle repeats? Very common. So first step is to run this type of report. Again, you can go into QuickBooks, grab, say, the last 12 months, run it by month, dump it into Excel, and you can do your margin analysis just like this. So what I'm looking for is, do I have stability in my margin percentage? Is it going up or down? What's happening? So if we kind of look at this, and again, it's hypothetical example, but we start at 60 and then we can see we've got a 58, 58.5. It's a little bit of erosion and now we're really starting to drop. So I can see this and hopefully if I'm running this quick enough, I'm going to catch this before it continues to decline. So the first step is just trend analysis, looking at these numbers. Do I have some decline? I do. Now I got to look at the specifics of what's the nature of these sales and cost of goods. Is this what's causing this? Is it maybe we implemented food and that's starting to drive the margins down. Maybe we introduced some new, to-go beer or other more merchandise, things of that nature. But we need to figure out what's causing the decline on a more granular level. But this first step is really just, do we have a decline? How are we going to spot it? Now, the other issue that I mentioned that's very common is we might run this and see that in January we had 60% margin, and then in February we had like 14%, and then March we had 79%. That happens a lot. And really what that's telling us is we've got some problems, most likely in our inventory. So when we're not counting inventory, we're not valuing it, we're not scrutinizing it, we can get a lot of volatility in the margins. And that can be very it's difficult to kind of analyze how you're actually doing when the inventory value is off because that margin's going to be off and then everything, your profitability is going to be off. It throws everything off. So that's just another way to use trend analysis to kind of see what's going on with your margins in particular. It's very common. So I'd encourage you to try that. Just go into QuickBooks, run a monthly report, dump it into Excel, calculate your margins, and tell me what you're seeing. And if you're consistent, it's good for you because it's usually when I run it, there's a lot of variability and it's just a trouble spot. The fifth red flag is wholesale margins are below benchmark. So the first question is, of course, are you in wholesale? Are you self-distributing? Second question is, do you know what your margins are for that channel of your business? So best practice is to go into QuickBooks, set up the classes so that you've got a wholesale class and a retail class. So you're basically dividing your income statement into two separate income statements so you can really see what's going on. And usually you'll see the margins on wholesale quite low, margins on retail quite good. And if we're only running it as a blended income statement, it really disguises what could be some potential problems. So that drag on margin. So that's first step is what are your wholesale margins? And the next step is what should they be? What are the benchmarks you should be looking at? So it's really going to depend on what products you're selling and if you're a premium price point and so forth. We generally say 40 to 45% margins is where you want to be. So when you run that income statement for wholesale, that's your target. Now, if you run it and it's significantly different, as it may be, then we need to kind of figure out, all right, well, why? What's going on? So the next step is to look at the product margins by brand and package. So this is just a simple spreadsheet tracker that you can use to grab these costs. Now, one of the challenges for folks that are using Ecos or Beer 30, Brew, Ollie, any of these, is they typically don't tell you anything about your labor and your overhead cost of goods sold. It's only going to show you what your material costs are, what your bill of material, what your recipes are, what's pulling through. So it does a good job of liquid and packaging and whatnot, but it doesn't tell you anything about labor and overhead, which are essential to know what are the fully loaded costs of my products so that I truly know what my margins are by brand and package. And almost every time a brewery runs this, there's some oh shoot moments. You'd be like, wow, I thought I was making. So in this example, maybe we got your flagship brand and it's going out in half barrels, sixtels. Maybe you've got some 6-pack 12 ounce, 4-pack 16 ounce. So our first step is to do the easy stuff. What's our price? So if we're selling again to a wholesaler, what's our PTW, our price to wholesaler? Those are easy we know those, fill those out. The next step is go to your ecos or your system and say, what are my material cost of goods sold by brand and package? And then it gets a little trickier. How do I fill out labor and overhead costs? The easiest way to do it is simply take, let's just say last year's total pool of costs for labor and overhead and divide it by the total number of barrels that you sold in that period of time. And then we're going to push that down kind of pro rata to each of the packages. So for example, one barrel, maybe labor was, we determined it's $50 per barrel. So for a half barrel, it's half of that, a sixtel, and so forth. So you can kind of push it down. It's not perfect, but it'll give you at least a decent approximation of what are my total cost of goods sold for labor, overhead, and materials. Overhead, so when we think about like, well, what labor goes in here? So it's anything, the general one sentence guidance on is it a cost of goods sold is to say, is this cost essential for the production and packaging of my beer? Said differently, could I make the beer without this cost? And then we'd be like, yeah, no, that's a cost of goods sold. So it's usually obviously anybody that's in production. If they're part-time, maybe you got an assistant that works in the tap room part of the time, then you can just allocate that amount of labor towards production, just kind of divide it up. Management salary goes in there as well. So it's really anything production and packaging related. Overhead costs, generally the most confusing one. So in this one, we want to try to keep it simple and say, again, what are the costs that are essential to production and packaging in my beer? Rent is a big one. Usually it's occupancy costs are the biggest one. And just the square footage for your production side of the business. Not that, you carve out the tap room. So we've got rent, we've got utilities, water, sewer, electric, gas, whatever you're using, insurance, depreciation. So those are kind of the big ones. There's a few others, but we want to first is get this directionally correct. So I tend to guide people to say, don't overcomplicate this. Take your big five overhead expenses, cost pool them, like aggregate them. What were they for last year? Divide the amount of barrels you sold into that, and that'll give you an overhead cost per barrel. Same process for labor. Then you can fill out this sheet. So now we've got, okay, a general methodology to aggregate our costs. We're going to match it up against our price to wholesaler. We're going to have our gross margin by brand by package. And then this is our financial shortcut is what's a gross margin percentage? So as I said, these are general benchmarks, but 40 to 45% blended is where you want to be. So our half barrels look pretty good. Sixtels look good. Oh, our canned product, this doesn't look good at all. Our packaged product, we're below 20%. Now, if we're selling a ton of draft and not much, this might not be a problem because maybe your blended wholesale margins are okay. But typically, you're going to see some, 50-50, 60-40. There's going to be a percentage that's down here that might be dragging. So to recap that, you start by looking at your wholesale margins on a blended basis on your income statement. Compare those to a benchmark, 40 to 45%. If you're outside of that, if you're below the target, we've got a gap. We need to identify the gap. So we got to go through and look at what is the nature of our portfolio by brand, by package. So this is essential if you're in wholesale or if you're in self-distribution. Now I should say this can easily be converted to PTR, price to retail, or if you're self-distro. So you just drop in the different numbers, see your margins there. Um, so yeah, I really encourage folks to dig in and understand those wholesale margins because they can be very problematic and they really hide. They can really hide, particularly if we're not running, those QuickBooks reports to see them discreetly, what's going on in our wholesale business. All right, our sixth red flag and our tool to identify it and spot it before it becomes a big problem is to run a financial health checkup. So these are four ratios, four metrics that you can look at to give yourself, you go to the doctor, they take your blood pressure, they weigh you, they measure you, they tap on things. So they're kind of doing a general financial health checkup. This is sort of the same thing for your brewery business. So the current ratio, debt to equity ratio, inventory turnover, debt service coverage ratio. So what are these things? So the current ratio is going to be a measure of our liquidity. It's basically saying, can we pay our bills on time? And the way the math works is we're just going to divide total current assets by total current liability. So if you go to your balance sheet, typically it's going to sum up and subtotal these items for you. So you run a balance sheet, you can do that right now. Look at your current assets, and current assets would be things like cash, receivables, inventory. It's going to look at your current liabilities, and that's things like accounts payable, payroll tax payable, things like that. And then you're going to come up with your target. Now, the healthy range here, 1.5 to 2 times. So your assets should be 1.5 to 2 times as big as your liabilities. If you're outside that spec, outside that range, we've got a potential red flag. The debt to equity ratio. So this one, along with debt service coverage ratio, is huge if you have debt. Debt is fine so long as it stays within these parameters. So debt to equity is really looking at the leverage. How well are you using debt? Are you over leveraged? Are you just right? And so it's really just kind of answering the question, did we borrow too much? What is that looking like? So the formula, the math on this ratio is take our total liabilities, and these would be our long-term liabilities, debt, divided by our total equity. So again, you run your balance sheet, and it's going to show these subtotals for you, typically in the liability section of those current liabilities, payables and whatnot. And you'll have the long-term liabilities, which is like your loans and other debt. Equity comes at the very bottom, and it usually has a combination of different things. So it's equity as one number. So equity could be what were the original contributions, shareholder contributions, investments. What are the net of the distributions that are made, retained earnings? So there's a lot in there. So you just take that bottom line equity number and divide that into your total liabilities. So really what we're looking for here is that liabilities aren't significantly bigger than equity. Banks like to see it no higher than typically, the whole no higher than 2 times. So meaning your liability is no more than 2 times the size of your equity. Now that can be hard to do if you're not in a super profitable position and your equity is really low or even in a deficit position. But you can run your balance sheet, check your liabilities, divide it by equity, and see where you stand in terms of this financial health checkup. The third one is a variation on what I mentioned earlier on the cash flow ratios. So this is inventory turnover. It's the same concept as basically how efficiently are we measuring our inventory? How operationally efficient are we? And what is the expected target? How many times should we be turning over a whole inventory over a course of a year? So our range that we're looking at is 4 to 8 times. Eight, higher is better. The math on this is we're going to take our total cost of goods sold and divide it by our average inventory. So you can run your P&L, say for last year, add up all your cost of goods, divide it by your average inventory. So you could take each month, divide it by 12. What's the average? Divide that thing in and see how many times you flip that inventory, how many times you turn it. So again, a measure of efficiency there. And the last one here is super important, debt service coverage ratio. So this is really measuring our cash flow strength relative to our debt obligations. Is the brewery generating enough cash to healthily cover the debt service? So the math on this is we're going to take this concept called EBITDA. You can also use the word net operating income. So EBITDA is basically earnings before interest, taxes, depreciation, and amortization. It's trying to show you a bit of a cash flow that we're then going to compare to our debt service. So get your EBITDA and then divide it by your monthly payments, your annual payments, principal and interest. And what we want to be able to see that EBITDA is higher than those debt service payments by a factor. Usually 1.5, higher is better. Your loan documents would specify, what your requirements are here. But typically it's, you want 1.2 to 1.5 EBITDA to debt service comparison. So if you take this numerically and just create a little dashboard, this can be a great way to kind of run this, monthly, quarterly to see where you are on a general health checkup and if we've got any red flags. So typically a red flag that I see is on a debt service coverage ratio. So I really encourage people as you're doing your financial planning, doing your monthly financial reports, just run this calculation. Like, what does it look like? Do we have a problem? Is it trending in the wrong direction? Because this can be a real snag if we trip that debt service coverage. The banks tend to start breathing down our neck. So it's better to be managing it, monitoring it, and then being proactive with our bankers to talk about, all right, here's what's going on. So the seventh and final red flag that I'll cover for today is if your key retail ratios are off target. Lots and lots of retail ratios you can measure. I'll share just three here. Front of house labor is a percentage of sales, back of house labor, which typically food prep, and then your food costs. So these would be your prime costs. So as we dig in on retail, the place we generally run into trouble spots is on food. We got to have food, but those margins aren't always super great. So we typically, benchmarks around prime costs. You've probably seen all these, but it's usually around 60% all in prime cost labor plus food costs. So that's kind of a target. Your front of house labor as a percentage of sales are really all over the place. To simplify, we usually just say 20% is your target. So 20% of sales, that's about where your front of house labor should be. But what I would encourage you to do is see what it's been in your brewery. Because I've worked with breweries where I'll say, yeah, we want the target around 20% front of house labor. And then I run their numbers and I look at their trends and they've been running around 12, 13. I'm like, "Ugh, 20, you can do better than you're at 12 or 13. Let's figure out what you're doing and see if we can even improve a little." So the first step is really get a baseline for what are your percentages for these retail ratios. Set your target, and usually the goal is better, right? So often people are like, "Well, where should I be?" I'm like, "Well, where are you?" Even on the food costs, a lot of times we'll say, "Yeah, 30, maybe 35% on your food," and I'll run it, and they're in the low 20s. Like you don't need to be higher. So these are general benchmarks, but I would encourage you to look at your own historical numbers and see where you are. And then it's the same process. What we're doing is we're saying, what is the target for food cost as a percentage of sales? What is our actual? What are the gaps? What are we going to do to close those gaps? Virtuous cycle. So if we're doing that regularly, daily, weekly, we got more cracks to A, identify if we've got a red flag, which in some cases we do on food costs, and then B, put those action items in place to address it. And I could talk about food costs for a long time, but there's so many opportunities in there to improve those margins. But the first step is just measuring them. So those are 7 ways to identify those red flags. Now, once you've identified them, now we got to fix them, right? We can say, yeah, I measured it, I checked the target, I identified the gap, I've identified things I'm going to do in order to close that gap, and then in our weekly financial cadence meetings, we're going to follow up. That you said you were going to do A, B, and C. Did it work? Well, A worked, B and C didn't. I still have a gap. I'm going to try X, Y, and Z next week. So it's each week following up that communication and accountability and really trying to diagnose what is causing this problem. If it's food costs are consistently, what is it? We got to dig in. So it could trace back to pricing errors. We got to look at pricing on the menu. If we're measuring, if I shift now from food costs to say just cash flow, we're constantly running short. What's going on? Could it be excess inventory or receivables? Let's diagnose that. Let's figure it out. Labor costs could be those scheduling inefficiencies. Let's dig in. But the first is measure it, monitor it, and ask why repeatedly until we can figure out what process is broken or what's the issue that's causing us to miss these targets. Another concept you can use is this stabilize first turnaround method because it can feel very overwhelming. Like once you run these ratios, you're like, gosh, I got gaps everywhere. Well, the first is just let's slow down, let's stop the bleeding, let's take the low-hanging fruit. So cutting discretionary spending, pausing projects that may be non-essential, and a big one that's often overlooked is renegotiating your vendor terms. It can be one of the quickest ways to just temporarily speed up the cash flow. Phase two is restore visibility. Really, that is getting more shots on goal, more reviews daily, weekly, not monthly. We just got to speed up our financial cadence. So implementing daily cash tracking, that ratio scorecard, so you know exactly where you stand. And then phase three is okay, now that we've stabilized, now we have visibility, let's fix the core operations. And one thing I would recommend here, as you've identified issues, is to have focus months because it can be hard to say, yeah, we've got, 18 things we need to fix. It's like, well, we're not going to do any of them because it's just going to become too big a task. But if we were to say, all right, we've got an issue with food costs, February is food cost month. We're going to dive in on this. We're going to really understand what's going on. We're going to implement some changes. Maybe it's inventory. All right, March is inventory month. So you get that idea. You can kind of spread it out a little, make it easy on yourself, and give yourself the time needed to really fix these things permanently. Some quick wins to think about for cash flow. Price increases are the quickest, easiest. I know nobody wants to hear that, but if you raise prices and maybe there's spots on your menu, your food menu, you can do this. That's the quickest way to get that bottom line and margin improvement. Taproom profitability and sales boosts. It's amazing what a big opportunity upsell training is. I say this all the time. I go to tons and tons of tap rooms. I literally, maybe once has anyone ever asked me, do you want beer to go? It's such an easy move, but we do need to train our staff and we need to understand that sometimes people don't want to be pushy. I totally get it. But that training is super, super impactful. And the data on this is remarkable. That you basically get a 5x improvement in your to-go sales if we just work on training our staff to sell to-go beer or other merch, events, loyalty programs, you name it. Focusing on those higher margin food items, focusing on maybe merchandise, another potential loyalty programs. I'm on a huge kick on these now, really reimagining the Mug Club. One of my personal pet peeves is you walk into a brewery and you're like, "Hey, I want to join your Mug Club." No, we're sold out. We only have 100 mugs and they're hanging up on the hooks, and we'll let you know if it opens. I'm like, "I want to give you money and you don't want to take it." It's crazy. So reimagine the mug club. Maybe think about this from a recurring revenue standpoint. Maybe it's not an annual mug club. Maybe it isn't. I don't need a physical mug. I just want to be part of your program. I want the bigger pour. I don't care if it's a generic mug. So, and then these recurring revenue can be a great way to smooth out. And hey, it's New England. We're seasonal. January is terrible. February's not much better. What if we had these loyalty programs where we can smooth out? And they exist. And there's a lot of really cool systems out there that can be employed. So let's bring it all together here by building a financial early warning system. So this is, again, the glue, the virtuous cycle, weekly financial huddles. This is your weekly financial cadence to review your numbers, to identify those red flags early and implement changes. We want to have an efficient agenda. There's got to be there's got to be discipline in order to make this work. So we pick the regular day and time. It doesn't change. We have people that understand what they need to plan and prepare for. And we come into these meetings and we're focused on the numbers. That's it. This is not a place for side conversations and rabbit holes and brainstorming. This is like, what are your numbers? What are your targets? What are the gaps? What are you going to do to close that gap? We'll talk next week and see how you made out. And then you're going to do it again and again and again. So it's kind of the only way to get where we want to get to. So if we've got these red flags identified, our goal now is to fix them. So ownership of the numbers, clear expectations, education and training. So this is a place for that. We're constantly talking about the numbers, and I think that's one of the biggest challenges in running any small business, and certainly breweries, is we maybe just don't make time to focus on the financials in a structured, rigorous, and disciplined way. We have all the time in the world to focus on, making new beers and maybe even tweaking our production process. And that's awesome and totally needs to be done. But that same type of approach needs to be applied when we're looking at our financials. So the big takeaway here is that these turnarounds, that's not like one huge move. It's almost never one thing. It's always a combination of a half a dozen, a couple dozen things. And it's about earlier awareness. So the breweries that survive and thrive are the ones that have these systems in place. They understand cash flow drivers, ratios, levers to pull, and they have that regular cadence that they can follow so that they have, again, 52 cracks a year to work on improving our forecasting, identifying red flags, and closing gaps. So with that, I'll give you one more chance here on the Mass Workforce Training Fund. If you scan this QR code, it's going to take you to a landing page with a couple of short videos from me. It says, what is the Mass Workforce Training Fund? So basically, this is a way for Massachusetts breweries who are eligible to get up to 100% reimbursement for training. I have a couple of courses up there. I'm going to be adding more. We're running it right now. If anybody wants to come in and just visit one of the classes, we've got one Thursday. I've got one Thursday at 2. Happy to send you complimentary invites so you can see what this is all about. So basically, you scan this. The other way to just shoot me an email if you want, and I'm happy to jump on a quick call with you and talk this through. So here's my contact information. It's just Kary at beerbusinessfinance.com. Do a quick video or a quick Zoom, show you how this works. Um, and then lastly, I'll say that that training program is not just my course. Like there's hundreds of training courses that are available for you. It could be staff training, it could be, safety training. So definitely encourage you to check it out and see if you can find something good in there because there's lots of great information. But um, so yeah, with that, Katie, I'll see if we have any questions or just open forum and would love to hear from anybody on the call if this hit the mark for you, if it missed the mark wildly, if I usually say, do you have any feedback, comments, grievances?
Thank you very much, Kary. My palms are definitely sweaty from all the math. Math is not my thing, but I appreciate that there are folks out there like yourself that can help steer us in the right direction. I'll give folks a minute or two to see if they want to jump into the chat with some questions. One question that I have for you off the top of my head is, what is do you have any kind of cautionary tales of people that are trying to dig themselves out and they made it worse? Or, do you have a definitely don't do this? And then we'll jump to Sarah Lee for with a question.
Sure. Yeah, I think one of the big challenges is, chasing volume because we think volume is going to fix it. And very often I have a lot of breweries that do this. They're like, we're going to go into wholesale because we know that we can get sales and that's going to get us out of this problem and we're stagnant in our tap room. And I say, before you do that, let's run the math. And I show them and I'm like, it's just not going to work. It's going to make it worse. And sometimes they'll come to me after they've already done it and they say, it's getting worse. I'm like, well, we're chasing volume. It's the wrong, not all sales is created equal. So those wholesale sales can really dig the hole deeper.
Yeah, that makes a lot of sense. Go ahead, Sarah, if you'd like to unmute yourself and ask your question.
Hi, Kary. Thanks for your time. I really appreciate you
Yeah.
giving us a little webinar.
Oh, you muted. You remuted.
Oh,
There you go.
sorry. I know how to do this, I promise. But thank you for your time and your expertise. I guess my question here is one of the things you talked about, and that I agree with, is that as an industry in general, we haven't done a particularly great job of being a little bit more finance focused. And you had also mentioned kind of ways to bring that into reality in the business. So I guess my question is, do you have any recommendations for key topics or drivers that would help train or motivate middle or upper managers to kind of think in these financial terms and view those as actual results?
Yeah, that's a great question. Thank you for that. I think mostly it's about meeting people where they are. Because I remember when I first started 20 years ago, I had to implement open book management, and I was training. It was at the wholesaler time drivers and warehouse folks and sales and admin, and most people just they don't know what I was talking about because I was saying, hey, we got to drive cash flow, and they're like, no idea. I drive a truck. I deliver beer. So we had to break it down and say, well, what's going to be like approachable and relevant for the managers that you're speaking of. So first question might be for them is what numbers are they tracking right now? Because they're almost certainly tracking something. And very often that can be a good launching point to say, that's great. You're tracking these two or three things. Let's work on, kind of creating a dashboard. And then let's sort of tie that to the overall financial outcomes of the business. And then, hey, you know what? Let's also, maybe we can measure, this other item. We do this a lot with taproom managers to say, they're out there doing the best they can with customer service and whatnot, but are we really tracking the things that are going to drive, revenue margins and profitability through the taproom? Are we tracking, usually we're tracking sales. Well, today's sales and last week's sales versus the week prior. Okay, that's good. But do we have a target? Usually not. So are we tracking towards things that make sense? So if I'm a taproom manager, maybe I'm measuring average spend per customer, maybe average, number of customers that come in. Um, Food's a big thing. What are we doing to measure not just sales, but the relative margins on those? So start with maybe just ask a conversation. What's important to them right now? Are they measuring anything? And that can be a good starting point. And then you can kind of layer in maybe, I'd say more complex. But at the end of the day, the goal is to show them how their actions and decisions make their way to the financial statements because most managers that I work with just don't think that's a thing. Or look, I have nothing. I remember working with the drivers. They're like, I have nothing to do with your financial statements. And then we said, well, you sure do. Your route efficiency, your customer services, you're merchandising the shelves. Everything you do is having an impact. So let's talk about maybe how to measure that and work towards improvement. So that's kind of how I would think about it. But as far as your weekly meetings, Sarah Lee, I would say that's just absolutely critical is to start it. Understand it's not going to be great. I can, if you like, I have a sort of sample agenda and some dashboards and whatnot. So we can say, well, what are we doing here? That I could send you if you want to try that out.
Thank you. I would actually love that.
And if it's okay, Carrie, I'd also love to just share it with the folks on this line and anybody else that is looking for the recording.
Perfect. Yeah, I'll send it to you, Katie, and you can push it out to whoever is interested.
Excellent. Any other questions from folks? I didn't see anything come into the chat. I haven't seen any other hands raised. So maybe, Carrie, you did such a perfect job that everyone knows exactly what they need to do now to get their bricks in order.
Or
Um,
they're overwhelmed and stunned. There's nothing wrong with that because that's usually it's sort of the what are the phases of grief? This is sort of the phases of how do I go from, being completely overwhelmed to actually getting some traction.
yeah. Well, the good news is Carrie's email is right on the screen as well as his phone number. If you have any follow-up questions, if you feel like you could use his expertise, certainly check out the programs and the grants that are available to get it covered for you. And we hope that you all enjoyed today's session. This upcoming Thursday at 10 a.m., we are going to be covering distribution best practices, and we have a whole slate of events every Tuesday and Thursday this month. So thanks everybody for joining us, and we'll see you soon. Thanks again, Carrie. Appreciate
Thanks,
you.
Katie. Take care.
Thank you.
Thanks.